So I want to introduce today, we have Andrew Massie from Plastridge Insurance. Andrew, you probably have that familiar face to some of the folks who might have been at Gillespie's or over in Palm Beach. How you doing today, Andrew? How's it going over at Plastridge?
Yeah, I appreciate it, Jeff. It has certainly been an active 18 months, a challenging 18 months.
To the least, yes.
So I appreciate the opportunity to be here and hopefully kind of shed some light on what's going on in the insurance market right now.
Well, I know that's a hot topic. A lot of people are asking. The reason we're doing this today as well, so many emails addressing what you just said. And before we get started, we live in a world of acronyms, okay? What does that CPCU after your name on your business card mean? And that was on the Zoom advertisement. What does that stand for? And how many of you are there?
Yeah, it's so CPCU is Chartered Property and Casualty Underwriter. It's a pretty rigorous designation. It's specifically for commercial insurance. As far as how many of us are there, I would say it's the least common one. I would probably say, somewhere between 1 to 5% of agents are probably CPCUs, just because of how it's an 8 exam, 8 course thing. So I'm glad I did it. Glad it's over.
Yeah, wow. So we are privileged. I mean, there aren't that many of you. This is great. So we have you today. That's fantastic. So we know you're going to be covering a lot of material, and we're going to get started with the CE credit portion of the program in about 5 minutes. Before we get started with that, how did the market get this way? Why do we have to do this? Why do we have to do a class about a challenging insurance market? How did it get this way in the first place? What are some of the contributing factors that led us to this point to have this class in the first place?
Yeah. So it's, insurance is actually a very, very cyclical market. And for most of us, if we look back at our premiums over a decade or 2 decades, you would see kind of periods where premiums are going up, going down. It's just a very cyclical market. Now, particularly for us, and we're going to get pretty detailed in this into some of the behind the scenes, but the most kind of obvious answer is that we're just seeing a sheer amount of catastrophic losses, just sheer losses. Yeah. Carriers are getting hammered right now. I mean, that's the bottom line. It's they're not profitable.
Okay. And it's not just, right now Surfside is on everybody's mind for the most part in the South Florida area. It's not just Surfside. We're talking weather events. When you say catastrophic, it could be hurricanes, could be fire. I mean, a little bit of everything, correct? Changing laws, that kind of thing.
Yeah, so it is. Insurance is very global. It's not just hurricanes, which that's what we think of, right? But it is a very global marketplace. Now, the challenge with something like Surfside is that, and you kind of hit it on the head, it's not just that one event, it's what that event is going to trigger. I mean, we're seeing, carriers requiring 40-year inspections everywhere, not just in Miami-Dade, and underwriting is getting very rigorous now as far as, we're seeing carriers require engineers reports, all of these things that we weren't seeing prior. So it's not just the event. A lot of times it's also what the event kind of triggers. Yeah.
And so how long do you think this is, I think I know the answer to this already, but it's inevitable that someone's going to type this into the Q&A. How long is this part of the cycle going to last?
Yeah,
the pressure's on. Let's go. You're like the weatherman. What's is it going to be sunny tomorrow?
I don't know. The weatherman can be right about 20% of the time and keep his job. So that's what I have to compete with. Yeah. No, but in all reality, it's a very challenging thing to forecast, just because, I would like to say maybe in the next 12 months, we start to see some of these premiums at least kind of plateau and level off. But the problem, Jeff, is that, in between that 12 months there, I mean, we've got another hurricane season in there. So it's very dependent on a lot of different events and seasons. So fingers crossed, knock on wood, we're hoping that this thing kind of starts to level out here soon, but we'll see.
And we're about to get started with the main event here, but that you just triggered a question too. Even if there aren't, let's say we don't have any named storms this year, but just the simple fact that storms seem to be more like a regular thunderstorm seems more intense today than it was 10 years ago.
Yeah.
Is that a contributing factor in the insurance equation as well? Just the fact that climate is somewhat changing a little bit, is that also a contributing factor? I'm just curious.
Yeah, it's not getting any better. That's for sure. I don't know if you're aware or followed it, but the NOAA seriously considered moving hurricane season back last year.
What do you mean back? Like starting earlier?
Starting May 15th as
Wow.
opposed to June 1st. So that was a serious consideration. That's something that's never been considered in the past, right?
I've never heard of it.
It's always been 6/1. So the fact that they're even contemplating something like that, I think answers that question.
Okay. Well, we're at about 9. I'm in a different time zone. I almost said 9:10. We're at 10:10 your time. So let's get started with the main event of today's presentation for CE Credit. Andrew, I'm going to turn over the floor to you now. Main event, once again, if you're just joining us, Andrew Massie, Plastridge Insurance, navigating a challenging insurance market. Andrew, please take it away. I'm going to shut up and turn it over to you.
Thanks, Jeff. I appreciate the intro. That's fantastic. Again, for those of us who joined late, my name's Andrew Massie. I'm with the Plastridge Insurance Agency. We're a family-owned insurance agency headquartered in South Florida in Delray, and I specialize exclusively in providing insurance for community associations. So homeowners associations, condominiums, co-ops, and we touched on this a little bit in the intro. Needless to say, it's been a very challenging 18 months as far as what the market's doing. So I had been working on kind of putting this course together for a while, and it's essentially a culmination of a lot of the questions that I'm getting frequently. And it's going to kind of be a twofold talk. First, we're going to talk on some of the behind the scenes. I feel that it's important that we kind of be transparent as opposed to what's actually going on, right? Not just that rates are going up, but also what's driving that and where that's coming from. And then we're also going to touch on some of the things that you can do as managers and as board members to better prepare yourself or better position yourselves going into your renewal, knowing that it's going to be a more challenging one. Now, just a little bit about me. Again, I specialize in providing insurance for community associations. I actually graduated from Florida State University with a degree in risk management and insurance. I'm a chartered property and casualty underwriter, very involved with the State Association for Insurance Agents, as well as the Florida State Risk Management Department. And of course, I'm a state-approved LCAM property manager CE instructor. Now, some of the items that we're going to touch on today, again, are kind of some of the behind the scenes, what's actually driving this challenging market. We're going to touch on some of the things that you should be aware of going into your renewal, things to look out for, such as terms that carriers are starting to change, different exclusions that carriers are starting to kind of put into policies that we weren't seeing prior. We're going to touch on Citizens, which is the market of last resort for property insurance in Florida. We're going to touch briefly on flood insurance. For those of your communities that purchase flood insurance, it's very likely through the federal program, and that program actually underwent essentially a total overhaul effective 10/1. So we're going to touch on some of those implications. And then we're going to touch on some things that you can do going in to better position yourself for your renewal. And then at the very end here, we'll kind of do a brief, very general market update as far as what we're seeing on the pricing side. So some very broad budget guidance. Now, the first thing, and we touched on this a bit, that's important to understand about insurance is that it's a very, very cyclical market. We have periods where premiums are going up and periods where premiums are going down. Needless to say, right now, we're absolutely in the upswing of that cycle. And there's a number of different factors that contribute to this. This is probably the most obvious, right? When we think of why our rates might be going up, why insurance premiums might be going up, we think of losses. Now, we have had kind of a 4-year stretch, a 4-year, 5-year stretch where carriers are seeing unprecedented covered causes of loss. And this kind of kicked off in 2017, which was the year that we had Hurricane Irma here. And then we also had Hurricane Harvey, which is the one that basically stalled over Texas for about 48 hours and caused some very, very severe flooding. And unfortunately, following 2017, which shattered, by the way, the record for covered causes of losses in a year at $138 billion with a B. Now, following 2017, 18, 19, and 20 were not much better. We saw very, very inflated claims throughout those 3 years. And 2021, we're still kind of quantifying the numbers at this point. They're still putting everything together, but unfortunately, it's not looking great. I read an article last month, and it said that Hurricane Ida that just passed through the New Orleans area is actually projected to be the costliest storm in Louisiana's history. So more so than Hurricane Katrina. And that was surprising to me, but it goes to show that these storms are just getting more and more severe and frankly, more frequent. So that's kind of the obvious one, right? The sheer fact that carriers are just experiencing unprecedented losses. But in addition to that, carriers are actually seeing unprecedented insurance litigation right now. And this is very specific to Florida, South Florida in particular. I read a statistic earlier this year, and I've referenced it over and over because I think it just does such a good job of kind of summarizing this and showing how serious this is. And it said that so Florida actually purchases about 8% of the property insurance across the country. So the entire United States, Florida buys about 8% of the property insurance, but Florida is actually responsible for about 76% of the insurance litigation across the country. So that is massively disproportionate. And what's happening for us here in Florida and South Florida, not only are we seeing increased losses, but carriers are actually having to spend more and more money settling these losses. So what's happening, it's kind of a two-headed dragon that's contributing to this, but at a very simple level, insurance carriers in Florida are just not making money. This chart here is actually a top 10 list. These are the top 10 writers of property insurance in Florida. It's very likely that every one of your communities that's on this call right now is insured with one of these 10 carriers. And look at how much red is on this chart. It's a highly unprofitable market right now and has been kind of over the past 4 years for carriers. And the insurance market is like anything else, right? It's like any other market in that if the carriers, if the companies involved aren't making money, they're going to make adjustments. And we're seeing that, of course, in the form of rate increases, but it's not just rate increases. We're also seeing a lot of carriers reduce their exposure in Florida, and they're doing this by playing around with some of their terms. So maybe you had a 2% hurricane deductible last year, and now you have a 3% or even a 5% deductible. We're also seeing carriers change their underwriting guidelines. So maybe they're saying, look, we're not going to insure any communities whose roofs are 10 years or older at this point. So they're shrinking their exposure that way. And we're also seeing carriers pull out of the marketplace entirely. And this is something that we've seen numerous carriers do over the past 18 months. And we just touched on Surfside a little bit. Obviously, a horrible, tragic situation, but Great American is the insurance carrier that was on Surfside when it collapsed. And they basically stroked a check and exited the Florida marketplace the next day. So what's happening is you as board members and as managers are finding yourself in an extremely challenging position where you're looking to buy a product that you have to buy in a market where pricing is increasing substantially and the actual pool of options is shrinking, right? So pricing is going up and supply is going down. That's not an easy market to navigate at all. And that's kind of the entire goal of what we're going to talk through today. If I can help your community kind of create, sort of a checklist or a list of items where if you take this to your renewal and you're asking these questions and you're having a conversation and talking through these different things, you'll be able to walk away from that insurance renewal knowing that you still have an effective insurance program, even though it was a challenging renewal, right? So that's the entire goal. And jumping in here, the first kind of item that I would encourage everybody to put on this checklist to have a conversation about at renewal has to do with the way that your insurance carrier values your roof. Now, at a fundamental insurance level, there's two ways a carrier can value your roof or your building or your contents. It's replacement cost or actual cash value. Now, the difference between these two is very simple. It's depreciation. If you have replacement cost coverage on your policy, then your carrier does not factor in depreciation. If you have actual cash value, they do. Now, I like to use a TV as a pretty relatable example of this concept. If you have a TV and you buy insurance on that TV, right, and you have a loss, a total loss to that TV, if you have replacement cost on that policy, then your carrier will actually make you whole again with a brand new 2021 TV of like, kind, or quality is the language that they use. The alternative, if you have actual cash value, your carrier is actually going to come in and depreciate your TV and cut you a check based on that depreciated value. Now you can see this is a very meaningful difference when you're talking about your actual claim payment, the check that you're going to receive. And the reason that I like to use a TV as an example of this concept is because, frankly, TVs are not that different from roofs, particularly in Florida, with regards to how quickly they depreciate. The reality is that if you have a 15 or 20-year-old roof and your carrier values that roof based on actual cash value, and you have a loss, you're likely going to recoup pennies on the dollar, if anything. It's a big difference when you factor depreciation in to a roof. And the reason I point this out is because we're seeing a lot of carriers start to try and switch the roof valuation to actual cash value. And it's very carrier specific. Some are doing 20 years, some are 15. I even saw a 12-year actual cash value endorsement recently, which is crazy, but it's absolutely something to have a conversation about. And the goal is going to be to keep these questions simple, right? I would encourage everybody to ask their agent at renewal, do we have full replacement cost on our policy? If you do, that's great. If not, if your carrier is playing around with the way that they're valuing your roof, that's something you need to be aware of and something that you need to factor into your decision when you're talking through options. Now, kind of sticking with roofs here, this is just one example of many that carriers are starting to put in to policies where they're trying to kind of limit their exposure for certain situations with exclusions. This one specifically is an exclusion of cosmetic damage to roof surfacing. And basically the way this reads is that if your community, if you experience a wind loss, so a hurricane, a tropical storm, a crazy overnight thunderstorm, anything like that, and the roof is damaged, if the roof still functions, basically, if the roof still functions as a barrier to entry of the elements, then there's no coverage. Now, again, this is very specific, and it's just an example of, hundreds that we could probably do another hour just on the different exclusions that we're seeing now. But the reason I put this up here is to encourage you, again, to keep the question simple at renewal, right? Ask your agent, is there anything new? Is there anything new in our insurance policy that we didn't have last year? Or is there anything that we should be aware of? Because these types of exclusions are definitely worth, having a conversation. And a lot of times, once you uncover these, it really just takes some pushback, and certain carriers are willing to remove these. But you're never going to get to the bottom of that if you're not having the conversation. Now, I do have this chat box here, and I'm just out of curiosity, how many of your communities have either switched to or have had a conversation regarding Citizens in the past 18 months? I'm going to kind of monitor these as they come in, but the reason I ask the question is because Citizens is the market of last resort for property insurance in Florida, and some of you are starting to chime in that you have, and it's not surprising because Citizens is getting more and more relevant by the day. Now, Citizens, again, is the market of last resort. And I put this up here because it's not just me saying that. It's not that, agents don't like working with Citizens or anything like that. This is actually right off of Citizens' website on their eligibility. It states, under Florida law, Citizens may write a new insurance policy only for property that meets one of the following eligibility criteria. Criteria 1, coverage is not available from a Florida authorized insurance company. So there's literally no other options. Criteria 2 is kind of a loophole to that. And this actually got increased this year, I believe. If your only alternative from another carrier, if the premium is 20% or higher than what Citizens is offering, then you can move to Citizens as well. Now, even though Citizens is definitely the market of last resort, it's necessary, right? It was created for a reason. There's a time and a place where Citizens make sense. We have had to work with Citizens over the past 18 months. We've had to move some of our communities over to Citizens, and it's very much a state of the market. When the market is challenging, we see Citizens become more relevant. This happened in 2004, 2005, after we had Wilma, and then Ivan, Francis, Charlie, and Jean, I believe, were 04. Citizens became very relevant then as well. And you see that if you look at the numbers. If we look at 2012, and this is all public information as well on Citizens' website, Citizens had about 1.3 million policies in place in Florida. If we fast forward to 2018, Citizens actually got all the way down to about 434,000 policies in force. So over a 6-year span between 2012 and 2018, Citizens actually reduced their policy count by about 1 million policies. And this was a very different market, right? This was a 6-year span where we weren't having consecutive storms. The insurance marketplace was a very different animal at this time. And what was happening is we were seeing carriers actually come into the market. We were seeing carriers come in that wanted to write the business. And for those of you that have been on the board or involved with the insurance conversation for a number of years, you probably remember the good old days, not too long ago, where we were actually sitting down with our community association clients, and we were talking through 3, maybe 4 options with different deductibles, and maybe talking through a 5% year-over-year rate decrease, right? So it was a very different market where a lot of communities were able to migrate away from Citizens. The market made that realistic. Now, if we look at today's market, if we go back to kind of January of 2020, where the market really started shifting, Citizens was at about the same number, about 443,000 policies in force. If we fast forward to September of this year, of 2021, Citizens has actually grown to almost 709,000 policies. So Citizens is growing at a rapid pace. And the reason that I kind of give this context here and wanted to talk through this, regardless of whether you've had to have the Citizens conversation or not, is because there's a very good chance that even if you haven't, you might be having that conversation here in the near future, just based on the state of the market, carriers pulling out, and Citizens becoming more viable. Now, that being said, if you find yourself having that conversation, my goal here is going to be to make sure that you're talking through some very specific things that you need to be talking through prior to moving over to Citizens. The first, and most of us are aware of this, Citizens is a bare bones insurance policy. The coverage is much different. You are not going to get a lot of the bells and whistles, the additional coverages with Citizens that you can get in the private marketplace. And it's simply because Citizens doesn't compete with the private marketplace, right? They're literally the market of last resort. There's no incentive for them to offer these coverages. So it's important that you're factoring in these into your conversation. The first being ordinance or law. Citizens absolutely does not offer ordinance or law. Now, for those of us who don't know how ordinance or law, or might not be overly familiar with how that works, it's essentially code compliance. If your community was to experience a loss, a hurricane, a fire, anything like that, and you had to repair or rebuild your buildings, you're going to have to bring those buildings up to the 2021 building code. And that margin there can get very, very expensive. I have seen some claims that are grossly inflated by the ordinance or law, because you're talking about wiring, plumbing, impact glass. Depending on how old your roof is, there's going to be certain things that you have to change with the straps, those types of items. And I promise you, I've seen it. That bill can add up quickly. And Citizens, again, just does not offer that coverage. It's not something that they're going to be offering. I would encourage everyone, if you're considering the jump, if you're sitting down and having the Citizens conversation at renewal, ask your agent to see a standalone ordinance or law option. So a separate policy that will provide coverage for the code compliance. Now, I will say this is not overly available right now. We're starting to see some underwriters put this product out there, but it's very likely that it's coming and it's going to become more available because the demand's there. And it's such a crucial coverage because it literally gets more and more important every year that you move further away from your data construction. Citizens policies also all include coinsurance. And for those of us who are not overly familiar with how that works, it's basically a fancy insurance term for claim penalty. And the way that it works is that if you have coinsurance in your property policy, what that means is that your carrier reserves the right to come in after you've had a loss, and they'll appraise your buildings. And if they feel that you were underinsured, they'll penalize your claim. So even if you have $1 million fire loss, if your carrier comes in after that loss and says, look, you're insuring this building for $30 million. We feel that you should have been insuring this building for $39 million. They'll penalize your claim. So you won't get the full $1 million payout. It can become very meaningful in a claim situation. And the alternative to this is called agreed value or agreed amount. This is something that's readily available in the private marketplace. And I would be very surprised if you didn't currently have agreed value, so long as you're not already with Citizens. And again, unfortunately, it's one of those things that Citizens is just not going to change. They have no intention of changing this, but it's something that you need to be aware of and factor into your decision, because it is an additional exposure that you'd be taking on that you don't currently have. Now, one more big coverage difference here. This is going to be the last very meaningful coverage difference, essentially, between Citizens and the rest of the marketplace. Citizens is a basic form policy as opposed to a special form policy. Now, what I mean by that is Citizens on a basic form policy only covers the items that are specifically listed in the policy. Whereas a special form policy, which is what I would say 97% of the private marketplace is, covers everything that's not specifically excluded from the policy. So you can see, based on that language, a special form policy is much more beneficial. It's much more broad. And you can probably guess where I'm going with this. Citizens, if you place all perils coverage with Citizens, it is absolutely a basic form policy. And that there's a coverage gap there. There's a number of things that are not going to be covered under a basic form that are picked up on a special form. The first and the big one that we're going to talk about is water damage. Under a basic form policy, you are not going to find coverage for water damage. So if you have, a pipe break, a water heater burst, any sort of internal water damage is not going to be picked up on a basic form policy. So it's very meaningful. Water damage claims are some of the most frequent claims that we see. That's not going to surprise anyone. And fortunately, here there is a solution. If you're considering Citizens and you're considering all perils with Citizens, meaning not just your wind coverage, I would strongly encourage everyone to ask for what's called a difference in conditions policy. It's a separate policy, and it basically fills this coverage gap. It essentially makes your basic form policy a special form policy. It's called a difference in conditions policy. And I will say, every community that we've moved to Citizens on an all perils basis has taken that coverage, because it's just too valuable. First off, it's relatively not overpriced for the bottom line insurance program in most cases, and it's just too valuable. Water damage, again, is one of the most frequent claims we see. So I would encourage everybody to factor that in and make sure you're seeing that option, whether you ultimately take it or not, at your renewal. Now, so Citizens, in addition to the actual coverage differences, right? Those are very, very meaningful. And I can't stress enough how important it is to be fully transparent and make sure you're talking through and understanding the additional coverage differences and exposures by moving to Citizens. But in addition to that, Citizens also has some very, very strict quoting requirements. So if you want to get a quote, or if you want to place coverage with Citizens, there's some items that you have to do prior to that. And I always say Citizens is a state-run pool program. You know, there's a time and a place, it's a necessary evil, but it's pretty similar to working with the DMV in that they're just not flexible. Their requirements are their requirements. It's basically, you know, comply or don't have coverage. The first of these is that you have to have an appraisal that is no more than 12 months old to place coverage with Citizens. You also have to have wind mitigation forms that are no older than 5 years. Now, the reason that I put this up here and want to talk through this is because I've been down this road. And if you can get ahead of this, if you can start having these conversations early, as opposed to scrambling and trying to update all of your documents, you know, within a 7-day window prior to placing coverage with Citizens, you can save yourself a serious headache and a lot of unnecessary stress. And for what it's worth, I mean, at this point, with where we are in the insurance market, it's no longer a secret. If you're, you know, 6 months, 8 months, 10 months out from your renewal, if you ask your agent, again, keeping it simple, is Citizens going to be in play for us next year? We are in a position, we can give you an answer to that. We can answer whether we think Citizens is likely to be a viable option or not. And if that answer is yes, I would encourage you to start these conversations early, sit down, get ahead of this type of stuff, particularly this one. This is going to be the big one for a lot of you. Citizens has very, very strict roof age requirements. Depending on how old, or what type of roof you have, it could be 15 years, 20 years. It varies based on roof type. But if your roof is older than Citizens requirements, they absolutely will not bind coverage. You cannot place coverage with Citizens if your roof exceeds their age limit. And to give you an example of how serious they are about this, I was having a conversation a couple months ago with a community that we don't currently work with, but that had moved to Citizens this year. And they explained that, you know, they had all the right conversations. They talked through the pros and the cons. The board ultimately decided to place coverage with Citizens. Fine. What happened is Citizens came out and they did their inspection, which is standard. Every carrier does that. But following their inspection, they came back and said that the roof was too old. They discovered that the roof was over 15 years old. It was a built-up roof, which a lot of your communities are going to have. Citizens issued a notice of cancellation that day. So they did the inspection, same day, they sent out a notice of cancellation effective in 7 days, unless the board found a roofer, signed a contract, and made a down payment to replace their roof. Now, I don't know about all of you, but I've pretty much found that it's very challenging to get anything accomplished in 7 days, let alone something as heavy a lift as signing a contract for a roof replacement in what's going to end up being, you know, a $500,000 project. So by having these conversations early, and again, you know, we're very sensitive to the fact that these are challenging conversations. You know, no one wants to be put in a position where they're being told you have to redo their roofs. That's not an easy conversation. That's not an easy scenario for a board to communicate to the community, but at the same time, getting ahead of it is crucial. If you can start this 8 months out, you're in a position where you can actually not only save the headaches. I mean, forget the headaches of having to scramble and do this. If you can get ahead of it, you can do it the right way. I mean, if you're put in a position where you have a week or 2 weeks or even a month to get this done, there's just no way that you can do it efficiently, right? So getting ahead of it can be very, very meaningful. One more item, one more citizens topic here, and then we're going to move on. This is something that's very important for everyone to understand. That's very, very specific to citizens prior to making that jump. Citizens is what's called an assessable insurance policy. What that means is that citizens actually reserves the right, if they become unable to pay claims. So if we have a catastrophic hurricane and citizens becomes unable to pay out claims, which by the way has happened in the past, they reserve the right to actually come back and assess every single one of their policyholders for an additional 45% of their annual premium. So just easy math. And this is actually right on the front page of Citizens website. It's a true cost calculator is what they call it. And it's on there so that their policyholders can actually go on, type their premium amount in, but actually calculate what they call your true cost of coverage. So again, just easy math. I used $100,000. If you're buying a $100,000 policy from Citizens, prior to purchasing that policy, you need to factor in the fact that in any one given year, your premium could actually be 45% higher. It could actually be $145,000 as opposed to $100,000. And again, it is what it is. There's no getting around that. It's a part of Citizens, but it's specific to Citizens. So that's not the case with other carriers. So it's important that you as board members and managers fully understand, the inner workings of Citizens and these additional exposures that you might have if you do elect or are in a position where you have to make that jump. So we're gonna have time for some questions at the end, but before we jump over to the flood insurance portion, I know that the property piece is the big piece, right? That's what everybody's talking about right now. Does anybody have any quick property questions prior to jumping over? Jeff, this is very accurate here. Citizens is definitely becoming common vocabulary again in today's market as it was after Wilma.
And I don't see any new questions at this point, so you can likely continue.
Perfect. All right, so
there's actually one question that just came in as I was finishing my sentence.
Sure.
From Erica. I understand Citizen has its own contractors, and see if you can make light of that question in the chat there.
Yeah, Erica, I think the question to paraphrase is kind of, does Citizens have relationships with contractors that they would prefer to use at the time of loss? They do, but I will say, Erica, that's not overly specific to Citizens. I'll say most carriers have contractors that they work with or recommend, and it's not, they don't always make you use them. I'm actually at my own personal home in the middle of a water and mold claim that's just getting towards the end here, but Tower Hill is the carrier, and they sent me their preferred list, and I got estimates from them and from a different contractor, and we ultimately ended up going with the contractor that I provided. So they do have those relationships, but it's not always you have to use our contractors. So I hope that it kind of answers that.
And let's do 2 more questions, then we'll move on. Not in the chat, but they're in the Q&A. One of our attendees is asking, and I'm assuming he's talking, this person is talking about Citizens. Is this because other carriers are getting out of the market? And I think you alluded to it earlier that they're sort of forced out of the market because all in all, like, we don't like to think of it as a business, but it's a business and they just losing money, right?
Yeah, absolutely. So the fact that carriers are pulling out of the market is absolutely contributing to this. And you know, we mentioned Great American, but there's been, you know, Lexington is really reducing their exposure. They were a very big player, and it does. I mean, again, it creates a market where, you know, price goes up, supply goes down. That's challenging to navigate, and that is what's contributing to Citizens. Absolutely. I hope that answers that.
And there's one question, it might be a resource. Ms. Doreen is asking, is there a list available that we can use with our insurance agents so we don't miss anything? I guess sort of a checklist. Is that a resource that's available somewhere out there, or maybe something y'all can provide?
So there is, and so the only thing with that, Doreen, is that this is very fluid, right? It's not like we can, you know, give a checklist that's, you know, you can just use going forward. It's very much a state of the market. So I think the best we can do is kind of have a conversation like we're having now, where we're touching on what's going on now and kind of what you can do about that. Alternatively, Doreen, you know, feel free to reach out to me after this. I'm happy to, you know, have a more specific conversation with you, but that's kind of the best resource as far as a checklist, I think.
Yeah, and in the brief survey that'll appear at the end, and again, it's just a few questions. There's one of the questions you can choose to have Andrew contact you, and it doesn't cost anything to have a conversation.
Yeah. Okay. So jumping over to the flood insurance portion, I would be curious to know as well how many of your communities, I guess, A, purchase flood insurance, and B, have heard of risk rating 2.0. And the reason I say it like that is because, so the National Flood Insurance Program is a federal program that operates under FEMA, and they provide probably 95% of flood insurance, particularly in Florida. And risk rating 2.0 is something that rolled out effective 10/1, October 1st of this year. Very, very meaningful. And the reason I ask who may have heard about that or is having conversations with their agent about that is because the NFIP was very non-transparent with regards to what this was going to mean. So much so that the flood underwriters that we work with inside the NFIP had to sign non-disclosure agreements with the National Flood Insurance Program as to what was coming. So we were not able to get much information at all. Fast forward to October 1st, this is a much bigger deal than anybody really anticipated. It's essentially a total overhaul of the flood insurance program. And the reason that the NFIP is doing this has been in the works for a number of years, and this is what they're trying to address. Some of you may be a little bit more familiar with this. This gets talked about a lot. It's a lot of articles touch on this. The National Flood Insurance Program is an unbelievably inefficient program. Right now, they're about $20 billion with a B dollars in debt, and they're only at 20 because the federal government forgave 16 in 2016. So if not for that, the National Flood Insurance Program would actually be about $36 billion in debt. Now, needless to say, if this was any sort of private company, private corporation, they would have been insolvent years, if not decades ago. So the federal flood program is finally trying to kind of get their arms around that and address some of the things that they feel are driving this unprofitability in the program. The first being the current grandfathering program. Now, off the top of everyone's head, I don't know if you can recall whether your flood insurance is grandfathered right now or not. If it is, I would encourage you to get way ahead of some of these conversations, because there's some big changes coming to that. Now, traditionally, you've been able to grandfather your flood insurance one of two ways: based on continuous coverage, meaning if you bought your flood insurance policy 10 years ago and you've made your payments and coverage hasn't lapsed and you've renewed that policy for 10 years, you're grandfathered in to those rates, those flood maps, those zones when you wrote the policy. Now, traditionally, we've also been able to go back and grandfather communities based on what's called built-in compliance. What I mean by that is that we've actually been able to quote a community's flood insurance based on today, based on 2021 rates. And we've also actually been able to go back and quote their insurance, their flood insurance, based on the rates, the maps, the zones that were in place when the building was built, built-in compliance. Now, here's how meaningful that can be for some communities. This is a current community association client. It's a high-rise tower on the water in Palm Beach County. Right now, we have them grandfathered based on built-in compliance into a 1985 flood zone. Their annual premium is $14,747. If they ever lost that grandfathering, or if we were looking to place coverage now, their annual premium would be over $131,000. So almost an 800% increase. And effective 10/1 with this overhaul, built-in compliance grandfathering is gone. There's absolutely no more going back and grandfathering into an older flood zone based on built-in compliance. They shut that down. Now, before I scare everyone off of our call, it's not immediate. They're not, if you're currently grandfathered, you're not jumping up right to your full risk rate, is what they're calling it. What they're actually doing is they're easing you into it. They're calling it glide pathing. Basically, they're going to be taking a year-over-year increase until you do reach that full risk rate. Now, silver lining here, sort of, is that the NFIP, again, is a federal program, and there's a cap, similar to Citizens. There's a cap to the increase that they can take year over year, and it's 18%. Now, they haven't come out and definitively said that every single grandfather policy is going to take 18% year over year until they get to their full risk rate. But based on my conversations with underwriters and various members and people involved with the NFIP and FEMA, we are taking a pretty conservative route here. When we're meeting with our community association clients and talking through budgeting and talking through what to expect, we're including this as part of our conversation, and we're encouraging everyone to factor in 18% on the flood as well as a worst case scenario. Now, if you go back and review your flood insurance policy after this, which I'm sure everyone is going to do, and you find that you are grandfathered, I would strongly encourage you to make a note and start paying that bill maybe 30 days early. And I say that not lightly. I'm personally not one to pay bills early unless I have to. But when it comes to flood insurance and these changes, if something were to happen, if you were to miss a bill, or if your flood insurance policy was to lapse or cancel for any reason, and you had to write a new policy, you would lose that grandfathering off the bat. You would, there's no more glide pathing. You would jump right to your full risk rate. And this has always been something that we've followed very closely as far as flood lapses, because it's a pain. It's a big pain to rewrite a flood insurance policy. But in the past, the conversation has always been, you know, look, this is a pain. It is what it is. You know, we're going to write this policy. We'll just built-in compliance, right? And grandfather you back into the grandfather rates. Remember, effective 10/1, built-in compliance is gone. So that kind of cushion or fallback there isn't there anymore. So if your flood policy lapses and you have to write a new one, there's no alternative. You're going to be losing your grandfathering, and we just saw how meaningful that can be for some communities. One more item here with regards to flood insurance, and then we'll move on. This is very specific. This is not going to be relevant to everyone. If you're a homeowners association or a townhome style association that buys flood insurance in each individual unit owner's name per your governing documents, I work with numerous communities that operate this way. I would encourage you to include this form in the paperwork when those units turn over. This is a flood policy assumption form is the name of it. And it's a one-pager. And what it does is it literally transfers the policy that's currently in place from the seller to the buyer. And you can probably guess where I'm going with that. The grandfathering comes with it. So again, pretty specific, but if it's relevant to you, this is another nice little kind of trick to help keep those lower grandfathered rates in place as long as you can. Now, I know that's a lot of less than positive news. I know that, you know, again, these are challenging conversations, and we appreciate that increases are not easy to navigate and not fun, frankly, but unfortunately, it is a state of the market. And what I always say, and I've kind of been, you know, reusing this, is that the difference between where we are now and where we were 18 months ago or even 12 months ago is that we know it's coming, right? It's not a secret at this point. So it's like anything else. If we know that our renewal is going to be challenging, we can prepare for it. So there's certain things that you as board members can do and as managers that are going to make this process a lot more simple, starting with preparing questions in advance. And we talked through some of this, but the bottom line here is get ahead of it. I know that's been kind of a theme, but start asking how old your roof is. Is Citizens going to be viable? Do we need to update our appraisal? Get ahead of these things so that you don't find yourself scrambling and trying to do all of this at once, you know, with a 14-day window. It can really make a difference. I also encourage everyone to meet with their agent early. And what I mean by that is not, you know, maybe we meet 2.5 weeks early instead of 2 weeks to do our renewal this year. I encourage everybody to kind of meet throughout the year and kind of create a transparent and really fluid stream of communication. Set up budget meetings. I think that most agencies have gotten their arms around this at this point and are doing a pretty good job of this. But as an agency from the beginning, we really took a proactive, if not aggressive approach to this, as far as, setting these meetings up and really talking through some of these rate increases and what we were seeing in the market. I would also encourage everybody to set up pre-renewal meetings. And depending on how your community operates, maybe this is part of your budget meeting, or maybe you set up an additional meeting 90 days out where you're talking through, are there any potential issues here? Any roadblocks? Do we have any outstanding claims? If you do have any outstanding claims, maybe you have a conversation regarding, whether there's anything you can do to move those closer to getting close. And I will say, if there's anything that you can do to move that in the right direction, getting those claims closed prior to your renewal can make a big difference as far as marketing. Not having open claims really opens up doors to carriers that otherwise just frankly won't quote if there's an outstanding claim. So that can be very helpful as far as marketing. And then I encourage everybody, when you're having these budget meetings, right? I understand they're challenging meetings, but there's certain things that you should be including in these meetings, not just the fact that prices are going up. If you're due for an updated appraisal, whether that's because you're a condominium and statute 718 requires you to do it every 36 months, whether Citizens is requiring it, whether your appraisal you feel is just outdated. If you're updating that appraisal, factor that in to your budget. Every once in a while when I'm making these courses, I find a picture or a meme like this that really appeals to the insurance nerd in me. It reads, the price of lumber is going through the roof that I can't afford to build because of the price of lumber. Now, I know that's sarcastic and it's funny, but it's true though, right? I mean, it's no secret that replacement costs, construction costs are essentially at all-time highs. So if you know that you're going to be updating your appraisal, it's very likely that your building values, your replacement costs are going to go up. And what that means is that not only are rates going up, but you're actually going to be buying more insurance, right? So I would encourage everybody to factor that in as part of their conversation as well. So it's not so that doesn't come out as a surprise.
So Andrew, since you have the picture of Keanu from Bill and Ted's, let's hear your best. Whoa. Let's hear you.
Whoa.
There you go. Okay, now you can continue. Now you can go on.
It's I almost feel that he was doing that in reaction to these insurance rates,
Exactly. Well played, my friend. Well played.
Now, in addition to that, and I know this is going to sound a bit obvious, a bit common sense, but if your community is making community improvements, so if your roof replacements, impact windows, those types of items, make sure that you're communicating that to your agent. Again, I know that sounds like a no-brainer, but there's been numerous scenarios where I've started working with a new community because maybe we pulled a roof permit that showed 2018 and their carrier was still using 2002, right? So if you're investing the funds and the time in making these improvements, make sure that you're reaping the benefits, right? And speaking of those benefits, if you are doing this, whether you want to or whether it's because it's a Citizens requirement, if you're replacing your roof or installing impact windows, quantify the insurance piece of that with your agent, right? I'm working through numerous roof replacements right now with communities. And what we've been able to do throughout this process is we've been able to set up kind of town hall style meetings where, I've attended and we've kind of presented, the insurance premiums with and without a roof replacement. And I've found that when you can quantify these things, it's a lot easier to sell it to the community, right? When you can actually demonstrate a direct positive impact it's going to have for them personally, it's helpful. And again, this is with regards to the roofs. If you find yourself in that position and are able to give yourself that runway, you can do it the right way, right? So getting ahead of this lets you get everybody involved, your attorney, your insurance agent. It allows you to set up those types of transparent town hall meetings. It lets you explore all the different financing options. Depending on where you're located, different communities offer different types of grants, property improvement grants, those types of things. So, you know, doing this with a reasonable runway will let you do this in a cost-effective and efficient way that can make a huge difference, you know, relative to scrambling and throwing this together. Now, so just briefly and very generally, right? Of course, the usual disclaimers. This is not specific. This is kind of generally what we're seeing with our community association clients at renewal time, and kind of the budget guidance that we're giving out there. On the property side, we're seeing 15 to 30, definitely trending towards the higher side of that year-over-year increases. The general liability market is proving to be challenging right now as well. We're seeing about the same 15 to 30% average increases. On the directors and officers, we're seeing about 10 to 20%. Flood, again, we're taking the conservative route, and we are encouraging our clients to budget for that worst case scenario, 18%. Crime bonds, we're seeing flat renewals. On the excess or the umbrella policy, which is the policy that goes over your general liability, directors and officers, and workers' comp, we're seeing substantial increases as well, 15 to 45%. And we're going to end on a positive note here. The workers' compensation policy that everybody buys, that I believe is about $616 annually, we're seeing about a 5% rate decrease there. So it's not all doom and gloom. So I know, Jeff, I don't know if you've been kind of monitoring questions that have come in, or if we've been saving it, but I'm happy to take some if there are.
Yeah, there's a couple. If you want to hit the Q&A button at the bottom, you can view them with me, Andrew. There's two right now. And we have a few minutes to go here on the advertised time. So I want to take a look at Donna's, and I'm not familiar with these acronyms, so I'm going to defer to you on this one, Andrew. Can you address LOMA and LOMR process? So I don't know what those means. Maybe you could elaborate.
Absolutely. So that's a good question, Donna. It's a great question with these flood changes. So LOMAs and LOMARs, they're letters of map amendments and letters of map letters of map amendments. And what they do is you can actually apply for a change in the flood map, right? So you can work with a surveyor and you can kind of create a narrative as to why the map should be adjusted. And traditionally, Donna, that has been very meaningful for two reasons. The first reason is because if you're right on the cusp of a high-risk flood zone, say maybe it's touching the corner of your building, what that means is that a lender is going to require you to buy flood insurance because you are in the high-risk flood zone. A lot of communities have done LOMAs or LOMARs to move that zone, so it's no longer touching their building, and therefore they don't have to buy the flood insurance, right? So that's been a common practice that is still viable. With regards to the rates, it actually no longer has that effect. So it's not relevant actually anymore to the rates. If you're shifting the LOMAs and LOMARs, and without getting too deep into it, the reason is because the new system, Risk Rating 2.0, actually underwrites every single individual building. The prior one didn't. The prior one had general rates that they were applying everywhere. So without getting too deep into that, it's not relevant for the rates, Donna, but it is relevant for lenders and whether you have to buy the insurance or not.
I forget to unmute. It's only been 2.5 years of doing this every day, and I forget to unmute. We have one more question from one of our attendees, and this will be the last one, as we promised we wouldn't keep you over the time here. Would a condo unit owner for water damage claim affect association insurance rates if the condo itself, if the association did not file a claim as repairs were less than the deductible?
It should not, Rich. And this was something after Hurricane Irma in 2017 that we really worked through, because those hurricane deductibles are a percentage of your values, right? They're meaningful. I mean, I have communities with $3 million deductibles, right? So what we were doing, Rich, is we were kind of keeping that fluid. We were kind of, reporting everything to our carrier and really putting them on notice, as opposed to opening a claim. And then as soon as we hit our deductible, that's when we triggered it and formally started the process. So if you're under deductible like that, it shouldn't have an impact.
Okay. Well, that covers all of the open questions, and I'm going to turn it back to Terry in a moment for some closing comments, but Andrew, we'll come back to you as well in just a moment. But before we do, I just want to mention, hang on just for a couple of more minutes. At the end, when we end this, there'll be a very brief survey evaluation at the end, where you can also ask for contact from Andrew about how he and Plastridge may be able to help your association. And Andrew, one thing I failed to ask earlier, this is on me. Can you cover the entire state of Florida?
We do. Yeah, we actually, the whole state.
Okay, and because we do have some attendees that from all over the state today here on this webinar, so I wanted to be sure. And Andrew, what is the best way for people to contact you other than the evaluation at the end? Do you want to share your phone number and your email?
Yeah, here we go. Here's my contact information up here. It'll have my email, and then my cell phone is on here up top. That'll always be the best way.
And can we get a PDF of this so we can share the slides with everybody in an email tomorrow? Is that something you can do for us?
Absolutely.
Okay. So tomorrow as well, at about 10 a.m. Eastern, you'll get an email with the same link for the evaluation if you missed it today, as well as a link to download these slides. So we'll make sure you all get that tomorrow. Terry, I see you're back. Let me give you an unmute button so you can unmute yourself and give some closing remarks before we give Andrew some closing remarks.
Muted. Can they all hear me?
We can hear you. You're back.
Okay. A couple of things. One is, everybody that's on the call, we want to make sure that you are getting our community flyers. So Jeff, how do we make sure that everybody can give you their email to make sure that they're getting blasts from you?
Well,
so for instance,
everybody that's on the call today, we have the email addresses, so we're good to go there. But tskmarketing.com is also where you can visit Plastridge, as well as our other providers that are partnering with our online presence. That's tskmarketing.com, and you can contact them directly. It's like a one-stop shop. Andrew, one more time, the best way to reach you is on the screen, correct? The cell phone, email. And do you have any closing words before we take it away today?
Yeah, no, this will be the best way to reach me. I really appreciate everybody taking the time, and I know it's a challenging market. So my goal was, and I'm hopeful that we were able to, is to just make this a little bit easier to navigate for some of you. So I'm hopeful that I was able to do that, and thanks for having me.
Absolutely. Thank you, Andrew. We can't wait to have you back. Again, you'll get the slides and tomorrow in an email, the survey as soon as we close this out, and a recording of this webinar will be, the link to the survey, SM, will be when we close that, when you leave the webinar, when we end it, the link will pop up for the survey. And this recording will be on the tskmarketing.com website within a couple of days. So with that said, have a wonderful, wonderful holiday season. Be safe out there. If you are traveling, take any precautions necessary. And we hope to see you back shortly after the holidays when we resume in full swing with everything. So thanks once again for Andrew, for Terry. Have a wonderful, wonderful holiday season. And if we don't see you before then, have a happy new year. Take care. Stay safe out there.
Thanks,
Bye,
Jeff.
everybody.
Thanks,
Thank you.
everyone.